Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market so you can understand what we see in the global landscape. Last week was a pretty great week for the U.S. markets. We saw a little pop coming back on the emerging markets. And generally speaking, the week before that, we saw kind of that swish on interest rates and also the stock market, we believe, kind of the bottom of the recent correction that a lot of people have witnessed. We had about a 10% correction from top to bottom. Things have already started to reverse back up. Generally speaking, these are our indicators. U.S. market and economies, generally speaking, are improving and growing. Some of the recent data we're reviewing this morning shows additional weakness over in Europe, which we continue to avoid, and a little bit of slowdown in some of the emerging market ex-Asia. Not a big concern. We do have a position currently in the emerging markets we are watching closely. We may actually spin or sell that position off in order to capture additional relative strength going into the last 2 months of this year. Also to capture a potential tax loss and shift that money over to use a tax loss against any other potential gain this year or in the future. Great management strategy. So again, if you own emerging markets within your portfolio, you may want to look at that strategy if you're not a client. Of course, we'll manage that properly for our clients. Again, we're seeing a little bit of slowdown in some of the emerging market economies. Nothing drastic, but ex-Asia, of course. Generally speaking, we're seeing positives as we get into year end. Some of the numbers that have come out on earnings over the last couple weeks, as I've talked before, excellent inside the U.S. We're seeing good positive earnings growth. And again, we're seeing some pretty good positive earnings growth in a lot of the emerging market economies in addition. The wild card, the slump is really, of course, a lot of the European economies, which again, I would say avoid, and we haven't been in those. I couldn't tell you how many years we haven't been into the European economies. It's been many, many, and we don't plan on going in those anytime soon. They're slow growth, bad growth, and if they do grow, it's substandard. Just economies you don't want to be into. There's too many other great places in the world to invest that are relatively strong on the earnings front, on the growth front, and of course on a relative strength performance basis. I want to talk a little bit about emotional investing and what we saw about 2 weeks ago. Kind of midpoint 2 weeks ago, middle of the week, we saw kind of this pretty substantial, about a 4% decline in the markets and then started recouping. And we saw about the same thing in the long-term treasury where rates kind of bottomed out about 1.85 and then kind of came back above 2 by the end of the day. That was almost a 4% move, also more on the positive side. What this tells me is this: there's a lot of hedge funds, big money managers out there that basically play both sides of the fence. Chances are they were short treasuries, which didn't work out for them this year because rates have come down a little bit. When rates, of course, come down, those bonds go up. And they were also, a lot of these were very long oil, and oil basically has gone down this year. So what we saw a few weeks ago, in our opinion, is some major hedge fund money selling out and basically gave you that kind of swoosh to the bottom. Remember, every year in the equity markets, almost across the board, we see about a 10% short-term correction. We've already made up a good chunk of that correction just in the last week. That's not to say we might not see some more bumpiness by the end of the year, but I can tell you, traditionally, the last quarter of the calendar year tends to be some of the better performance numbers out of a lot of the equity markets. No guarantee to future results, but we feel we're properly positioned. As I made a comment earlier, we may be making an adjustment to our emerging market exposure for tax purposes and relative strength going into year end. If you're a client of our firm, please call us with any of your questions. If you're not a client and want to become a client, call our firm for a consultation. There is a difference. We do invite you to experience it. Have a safe and profitable day.